Hello and welcome to Investment Insight. Before we begin, make sure to subscribe and hit the like button. Now let's break down what's happening in the markets today in a clear and simple way.
Thanks for having me. There is definitely a lot to break down today.
There really is. We're doing a deep dive today into a market that, honestly, it feels a bit like a magic trick.
Yeah, that's a good way to put it. An illusion.
Exactly.
Yeah.
Because looking at the recent analysis, the S&P 500 right now in June 2026, it looks totally calm on the surface. But underneath that, like nearly 60% of its stocks are actually just drowning.
It's phenomenal. The broader indices are, well, they're basically masking this massive underlying destruction of wealth.
Yeah.
And it's catching a lot of everyday investors completely off guard. Like people
Yeah.
are getting wiped out without even realizing the water is rising.
I totally want to dig into how that's even mathematically possible. But first, let's just establish the general environment we're operating in right now for you, the listener. Because for anyone just trying to manage a 401k, or maybe you're just starting to put a few bucks into the market, things feel completely chaotic.
Absolutely chaotic.
We're seeing these wild, violent swings in individual stock prices. Mostly, anything remotely connected to artificial intelligence or the tech sector.
Right. The velocity of the market right now is just unprecedented. I mean, you have information moving instantly and capital moving just as fast,
Yeah.
which creates these scenarios where the fundamental rules of investing are basically just being thrown out the window in favor of pure momentum.
And that actually brings up a really great mental image from the research.
Yeah.
Based on the data, the current market is being compared to a raging flash flood.
I love that analogy. It's so accurate.
Right. So imagine you're standing on the muddy banks of a river. The water is just churning. It's violent. And suddenly, you see this shiny, massive gold nugget washing past you in the current,
And you want it.
obviously.
Yeah.
That gold nugget is basically the tech stock that just surged 10% in a single day.
Yeah, and it's the ultimate psychological trap, honestly. I mean, human beings are hardwired by evolution to lock on to the shiny object.
Right. The immediate reward.
Exactly. We see the gold and we completely fail to calculate the velocity and, the sheer danger of the water carrying it. We just want to jump in.
But wait, hold on. Let me push back on that for a second. If the gold is visibly right there in the water,
Uh-huh.
and I literally just watched my neighbor jump in, grab a piece, and double their money yesterday, how is it a trap? The reward is real. People are actually making money.
Sure they are.
So as a beginner, it honestly feels completely irrational not to jump in with them.
I get that. But look, your neighbor got lucky on the timing. And relying on luck is just, it's not a real investment strategy. Behavioral economists actually call this the probability illusion.
The probability illusion. Okay, break that down for me.
Well, the massive size of the potential reward, that shiny gold, it completely blinds everyday investors to the deadly speed of the current. So they see a stock surge 10% and think, if I just get a little piece of that momentum, I win.
Yeah, I just need a sliver of it.
Right. But here is the structural problem with jumping into a flash flood market. That surging stock, it already has all of the market's absolute highest, most crazy expectations completely baked into its current price.
Okay, meaning the price isn't even based on what the company did yesterday.
No, not at all.
It's based on the assumption that the company is going to execute flawlessly for like the next 5 years.
Exactly that. Every single ounce of optimism is already priced in. So if their next earnings report is just slightly less than perfect,
Oh, I see.
or if there's like a minor supply chain hiccup, that stock doesn't just dip, it plummets. The water sweeps you away.
Wow, okay. So the alternative is what the analysis calls proven farmland. And I really, really like this framework.
It's a much safer way to think about it.
Right, so instead of diving into this flash flood to grab a fast-moving nugget of gold, you just buy a plot of land. You take the time to actually check the soil quality, you secure a water supply, you calculate your fertilizer cost over the next decade, and you just plant seeds.
Yeah. It requires patience, which is something in a very short supply in a high-speed economy right now.
Nobody wants to wait.
Exactly. You're not going to double your net worth by Tuesday morning with farmland, but the probability of long-term compounding success is infinitely higher.
Because you're relying on actual math, not luck.
Right. You are relying on the fundamental mechanics of a growing business rather than just the chaotic momentum of a crowd.
Okay, but this brings me to a big question. If this flash flood is actually happening right now, why does my retirement account look totally normal?
Ah, right.
Because when I look at the headline numbers for, say, June 9th, 2026, it doesn't look like a flood at all. It looks like a perfectly sunny day.
And this is where we have to peel back the curtain on how market indices actually work. Because the headline numbers you see on the evening news, they are heavily, heavily distorted by the sheer size of a few specific companies.
Okay, give me the actual data on that. Like, how distorted are we talking here?
So on that specific day, June 9th, the S&P 500 only dropped a tiny fraction, like 0.3%.
That's nothing.
Right. And the Dow actually went up 0.2%. So if you just read the little ticker at the bottom of the screen, you would assume the American economy had a perfectly quiet, totally stable day.
Yeah, I'd sleep like a baby.
But underneath that surface, roughly 60% of the individual stocks inside the S&P 500 actually lost value that day.
50%. That's huge.
It is. The entire market is basically being artificially propped up by a tiny handful of mega-cap tech and AI companies.
So basically just a few giants literally carrying the entire weight of the market on their shoulders.
They really are. The S&P 500 is what we call a market cap-weighted index.
Okay, meaning what exactly?
That means the bigger a company is, the more influence its stock price has on the overall index number. So if a $2 trillion tech giant goes up by 2%, it can completely hide the fact that 300 smaller companies just had a terrible day.
Okay, that makes perfect sense. So it's literally like looking at a perfectly smooth lake, but right underneath, there is this vicious undertow dragging down the majority of the companies.
Exactly. A really great way to visualize this concept, which financial analysts call market breadth, is to imagine a choir of 500 people.
Okay, a choir.
Yeah. So you walk into an auditorium and the music sounds incredibly loud. You'd probably assume, wow, this is a robust, healthy choir.
Sure.
But then you look closely and you realize 495 people are completely silent. And only 5 people are screaming at the top of their lungs into massive amplifiers.
Oh, wow. That is not a healthy choir at all.
No, it's not.
And if those 5 singers lose their voice, the entire concert is just over.
That is the exact structural risk we're talking about. When breadth is this narrow, the index just gives everyday investors a totally false sense of security. So to see the real picture, analysts look at something called an equal weight index.
Okay, so how did that change the math for us?
In an equal weight index, every single company gets the exact same influence. From the massive trillion-dollar tech giants all the way down to the smallest regional bank in the S&P 500.
So the amplifier is turned to the exact same volume for all 500 singers.
Exactly. And when you look at the equal weight metrics for the current market, it is basically flat or even trending downward. The median American business is actually struggling right now, even while the headline index hits all-time highs.
That perfectly explains why the massive volatility is basically invisible unless you really know where to look.
Yeah.
And man, when those big tech names do stumble, the wipeouts are just historic. Like, the data from early June shows Broadcom lost $286 billion in market cap in a single trading day.
It's insane.
And Micron dropped almost 8%.
Losing $286 billion in one afternoon is, it's difficult to even comprehend that number.
It doesn't even sound real.
It's the equivalent of the entire gross domestic product of a mid-sized country just simply evaporating between your morning coffee and your evening commute.
And then on the flip side, you have these bizarre artificial bumps. Like, the analysis noted that Marvell Technology jumped 9% in one day simply because it was announced they were being added to the S&P 500 index.
Right.
They didn't invent a new microchip overnight. They didn't double their sales.
No, it is purely a mechanical move. See, when a company is added to the S&P 500, every single passive index fund and 401k plan in the world that tracks that index is suddenly forced to buy shares of that company.
Oh, because they have to mirror the index.
Exactly. It creates this massive artificial wave of buying pressure that drives the price straight up, regardless of the underlying business fundamentals.
Which honestly brings us to the actual tools everyday people are using to try and capture these massive daily swings.
Yeah.
Because if you're an everyday guy and you see a stock jumping 9% on a mechanical technicality, the temptation to game the system is huge.
It is.
And the data here is honestly terrifying.
The behavior we are seeing in the retail investment space right now is incredibly alarming.
According to a recent analysis by Reuters, nearly 90% of all trading volume in single-stock leveraged ETFs comes from retail investors.
Yes, 90%.
So we aren't talking about Wall Street hedge funds hedging their massive portfolios here. We're talking about everyday people using their personal brokerage accounts on their phones, piling money into highly volatile, 2 times leverage trackers for individual stocks like Nvidia, Tesla, Broadcom, and Coinbase.
It's extremely dangerous. Using a leveraged ETF on a highly volatile single stock in this specific environment is the equivalent of tying a heavy iron weight to your ankle while reaching for that gold nugget in the flash flood.
Wow.
It actively pulls you under.
Okay, wait, I need you to explain why that is. Because on paper, and I think a lot of beginners listening probably think this, if I strongly believe an AI stock is going to go up over the next year, and I buy a fund that promises me 2 times the return of that stock, it sounds like a brilliant cheat code.
It sounds great in theory, sure.
Right. If the stock goes up 20%, I make 40%. So why does the math actually punish you for holding that long term?
It comes down to a mathematical quirk called volatility drag, and it is absolutely crucial for anyone buying these products to understand how it mechanically destroys your capital.
Okay, I'm listening.
These leveraged ETFs are designed to track the daily return of a stock, not the long-term multi-month growth. They reset their leverage every single night.
Okay, walk me through the actual math of that daily reset. Let's do a comparison. How does a normal stock compare to a 2 times leveraged ETF over just a couple of days?
Okay, let's use really simple round numbers. Imagine you buy $100 worth of a regular stock.
Okay, I got my $100.
On Monday, the market has a bad day, and the stock drops 10%. So your $100 is now worth $90.
Simple enough.
On Tuesday, the stock recovers. But to get from $90 back to your original $100, the stock actually needs to go up about 11.1%.
Right, because the baseline is lower.
Exactly. Let's say it does exactly that. The regular stock went down, came back up, and you are sitting flat at $100. You survived the volatility unharmed.
Got it. I'm exactly where I started.
Now, let's look at the exact same 2 days, but this time you bought the 2 times leveraged ETF for that stock. You start with $100. On Monday, the underlying stock drops 10%.
Okay.
Because you were 2 times leveraged, your ETF drops 20%. You are now down to $80.
Ouch. Okay, so a steeper drop, but I'm leveraged, so I should bounce back faster on Tuesday, right?
That is the logical assumption, but here's where the math totally bites you. On Tuesday, the underlying stock goes up that 11.1%. Your 2 times leverage ETF goes up 22.2%.
Okay, nice.
But, and here's the catch, it goes up 22.2% from your new lower balance of $80.
Oh, I see where this is going.
Yeah, 22.2% of $80 is roughly $17.76. You add that to your $80, and your final account balance is $97.76.
Wait, so the guy holding the regular stock ended up perfectly flat at $100, but because I held the leveraged ETF, I actually lost over $2, even though the underlying stock recovered to its exact starting point.
Exactly. You lost over 2% of your capital in just 2 days of sideways trading. That is volatility drag.
That is wild.
Now imagine that compounding over 30, 60, or 90 days in a market that is swinging violently up and down every single week.
That literally just bleeds your account dry.
Think of a leveraged ETF like putting a powerful magnifying glass over a map. It makes your destination look twice as close, which is great. But it also magnifies every single pothole and speed bump on the road by a factor of 2.
That's a great way to picture.
And if the road is incredibly bumpy, which the June 2026 market absolutely is, that magnified turbulence will destroy your vehicle before you ever reach the destination. These are surgical tools meant for day trading professionals to use for like a few hours.
Right.
They are completely toxic if held in a long-term portfolio.
That is a brutal reality check for the retail investors making up 90% of that volume. But I do want to make sure we don't swing the pendulum too far the other way here.
Fair enough.
Just because the stock market mechanics are dangerous, and just because leveraged ETFs are a terrible idea for a beginner, that doesn't mean the artificial intelligence boom itself is just smoke and mirrors.
Oh, absolutely not. That is a vital distinction to make. The financial hype right now is completely disconnected from reality, but the underlying structural shift in the global economy is very, very real.
Right, because based on the data,
Yeah.
the shift to AI infrastructure is driving massive physical changes. We aren't just talking about chatbots or like a new software update.
No, we are talking about the construction of colossal data centers. Millions of specialized memory chips, heavy upgrades to local power grids, and these advanced liquid cooling systems for the servers. This is physical steel, copper, and silicon.
And you can actually see the footprint of AI in global trade data right now. For instance, recent reports showed that China's surprisingly strong export numbers in May were directly driven by this massive global demand for memory chips and AI-related tech.
Exactly. When a technological concept starts physically altering international shipping lanes and export volumes, you know it has real structural teeth.
But the problem is that long-term reality is just buried under an absolute avalanche of short-term macroeconomic noise. I mean, the market is constantly distracted.
Oh, constantly.
We have giant IPO hopes for companies like OpenAI and SpaceX sucking all the oxygen out of the room. You have investors obsessing over CPI inflation data.
Yep.
You've got everyone tracking how the current Trump administration's trade policies and new tariffs might impact the cost of importing those exact same microchips. Plus, you have tensions in the Middle East. It's just a lot.
And all of those macro factors directly impact the AI buildout. For example, AI data centers require an astronomical amount of electricity just to run and cool the servers.
Right.
If tensions in the Middle East cause global oil and natural gas prices to spike, the operational costs for those data centers skyrocket instantly. And that spooks investors, which leads back to the violent swings we were discussing earlier.
Okay, so let me ask the obvious question then. If the export data literally proves that AI is the future
Uh-huh.
and is physically changing the global economy right now as we speak,
Uh-huh.
shouldn't I just buy the best AI companies? Regardless of the current price, doesn't decades of future growth eventually just fix a high purchase price today?
That is perhaps the most common and honestly most dangerous assumption in investing. There is a golden rule that every investor needs to memorize right now.
Okay, let's hear it.
A great company bought at a terrible price is a terrible investment.
See, that feels completely counterintuitive.
Yeah,
If the company is great, why is the investment terrible?
because you are buying the stock, not the actual product. You have to ask yourself, how much of this company's future perfection is already baked into the price I am paying today?
Okay.
If a dominant AI company is currently priced as if they are guaranteed to cure all human disease, colonize Mars, and invent infinite free energy by next year,
Right.
then they have absolutely no room for error.
They basically have to achieve the impossible just to justify the current stock price.
Yes, even if that company executes brilliantly, doubles their revenue, and releases incredible new products, the stock price might still crash simply because they didn't meet the completely impossible euphoric expectations that were priced in by that flash flood of investors.
Wow. So you're paying for a fantasy, and when reality hits, even a very successful reality, the valuation just collapses. So what does this all mean in practical terms? Let's move from economic theory into actionable steps for you listening right now. If the index is masking a massive undertow, and leveraged ETFs are destroying capital, and even great AI companies are wildly overpriced, how do you actually build your farmland in this specific environment?
Well, the analysis points to some very clear, disciplined rules for surviving this kind of high-velocity market. And the first rule is entirely about defense. Position sizing is far more important than stock picking.
Okay, explain what you mean by position sizing.
If you find a stock you love, but it's one of these volatile names that swings 10% a day, and you make it 40% of your total retirement portfolio,
Oh boy.
you are no longer investing. You have created a survival risk. If your thesis is wrong, or if a macro event hits that specific sector, your financial future is completely wiped out. You have to size your position so that even if a stock goes to zero, your overall portfolio survives.
Okay, the second rule the data points to is avoiding the urge to jump in all at once.
Yeah.
It's about dividing your entry points over time, what we generally call dollar cost averaging.
Right. Going back to our farmland analogy, you don't buy a seed, plant it in the dirt, and then dump an entire year's worth of water on it on the very first day, just hoping for an apple tree by tomorrow morning.
That would just drown the seed.
Exactly. You water it steadily a little bit every week, regardless of the weather.
And mechanically in the stock market, that means if I have, say, $10,000 to invest, I don't drop it all on a Tuesday just because the market looks good on TV. I invest $1,000 a month for 10 months.
Precisely. By buying a little bit at regular intervals, you completely remove the emotional stress of trying to time the market. I mean, you will inevitably buy on some days when the market is at an all-time high, and you will buy on some days when the market is crashing.
Yeah.
But over time, your average purchase price smooths out those violent daily swings, and you just capture the true long-term value of the asset.
That makes a lot of sense. And that brings us to the final and I think really the most profound takeaway from the research. You have to truly understand what a well-known asset actually is.
Hmm.
Because honestly, in 2026, we are bombarded with financial news.
We really are, nonstop.
Right. And just because you have heard the name of a tech company 1,000 times on social media, or just because their CEO is famous, does not mean you actually know the asset. Name recognition is not financial knowledge.
It's a critical vulnerability for beginners. People constantly confuse familiarity with safety.
So how does someone honestly test themselves? How do I know if I actually understand the farmland I'm buying, or if I'm just blindly trusting a shiny logo?
You really need a strict mental checklist. Before you allocate a single dollar to an individual company, you need to be able to answer 4 questions out loud, clearly and simply.
Okay, let's hear the checklist. What's first?
First, how does this company actually make its money? And I don't mean what their fancy vision statement says. I mean, what physical product or service do they sell to generate cash?
Yeah.
Second, what are their profit margins? Like, are they actually keeping the money they make, or are they burning through it?
Okay. And third,
Third, who are their 3 biggest, most aggressive competitors? If you don't know who's trying to eat their lunch, you don't know the business.
that's a good point. And what's the fourth question?
What happens to this specific company in a worst-case macroeconomic scenario? If interest rates double tomorrow, or if global supply chains freeze under new tariffs, does this company have the cash reserves to survive the winter, or do they go bankrupt?
Right.
If you cannot answer those 4 questions, you are not investing in a business. You are just gambling on a ticker symbol.
And the ultimate irony here is the companies that are the easiest to understand, the ones with clear revenue, obvious competitors, and boring, predictable margins, they rarely make the front page of the financial news.
Never.
They don't jump 10% in a day,
Yeah.
but they are the steady, reliable soil that actually grows wealth over a decade.
The boring assets are very often the most mathematically beautiful over a long enough time horizon. They just compound quietly in the background while the flash floods wash the gamblers away.
That perfectly encapsulates the entire mission of this deep dive today. Navigating the chaotic market of June 2026 isn't about having a crystal ball. It is not about possessing some magic ability to guess which AI tech stock will surge tomorrow afternoon.
No, not at all.
It is entirely about building a structural defense, sizing your positions, averaging your entry points, and truly knowing your assets so that you limit your losses when you are inevitably wrong about a trend.
It's about surviving the flood so that you actually have capital left to plant the fields. And, that leaves us with a critical, practical question for you to explore on your own today.
Yeah, let's give them some homework.
Take a hard, honest look at your own portfolio, your 401k, your brokerage account. If the entire market dropped 10% tomorrow morning, do you know exactly which of your investments are gold nuggets currently washing away in the undertow, and which are resilient seeds safely planted in the soil?
That is a fantastic reality check to end on. Don't forget to subscribe and hit that like button.